How's it going, folks? You know what we're here for. We're talking about Disney earnings. I hope you're excited because I know I sure am. They reported yesterday after hours, and as you see, the result pretty negative at the moment. It did start out pretty positive. We're talking about an over 3% gain. And then the natural market sentiment of negativity took over, unfortunately. So we're going to look at these earnings, and I'll tell you, thank goodness I don't have the camera on anymore because, let me tell you, it's too hot in here to have the camera on if you catch my drift. That's all I'm going to say. Don't need a Jeffrey Toobin type situation, okay? But as you can see, obviously Disney, talk about a shellacking year-to-date, down 35%. In the last year, down 43%. It's been a rough time, even over the last 5 years. That's right. Disney is down over the last 5 years at this point, despite adding an entirely new wrinkle into their business. They're down over the last 5 years. So a lot to talk about with Disney, but we're going to talk about these earnings first. They show a non-GAAP EPS line of $1.08, missed by 11 cents. I don't really care about the non-GAAP line. All things considered, we'll be looking at what the net income line looks like because that is a concern for me. As we continue to talk about content spend for the Disney Plus sector. I mean, that's a big issue when we're talking about spending $200 million on each series. It's quite expensive. It really is quite expensive when you consider that. So, something to think about. Revenue line came in at $19.24 billion, which is up 23.3 year over year. Misses by $800 million. And again, I thought they were hitting the $20 billion line. That's my bad. I 100% thought they would. I felt pretty decent about these numbers. And I don't really feel bad about this miss. I really don't. All things considered, we're talking about a 23% increase year over year. And really in some of the segments, as we'll get into, we see a lot of good numbers. Now, again, the only reason that this stock showed a positive reaction in the after-hours trading was because of this Disney Plus subscriber number. 137.7 million subscribers versus 129.8 of last quarter. They gained 8 million subscribers in a quarter. So this prompted some positivity, which makes sense. It should warrant positivity. When Netflix is losing subscribers, Disney Plus gained 8 million. So let's just be clear with one another. They're not blaming Russia or anything in this. Netflix did. So Disney Plus gains 8 million, and you know what happens to them? They get shellacked still. They still get shellacked. It's crazy. Subscriber data is all that matters with this company right now, and they're still getting hammered. It's crazy. So we'll get into some of the segments here, but we'll look at the press release and see what you get. So one thing that they'll mention here is revenue. Obviously, they mentioned there, but they say there was a $1 billion reduction for the amount due to a customer to early terminate license agreements for film and television content delivered in previous years in order for the company to use the content primarily on our direct-to-consumer services. Yeah, so that's a line that hurts them, $1 billion. You know, that is the $800 million that they missed by, but I get that. They should have accounted for that, but I guess, you know, analysts didn't. But I'm not too concerned there. Diluted EPS here. This is what we look for. Came in at 26 cents versus 50 cents of the prior year quarter. Yeah, and again, when they talk about excluding certain items, the non-GAAP line did increase, but from an actual net income standpoint, you saw quite the decline there. And again, I think a lot of this comes with, unfortunately, the cost of doing business with Disney Plus. It's kind of the cost of doing business. Total subscribers for the all of their platforms here have reached 205 million. Very nice for them, all things considered. We look at a revenue standpoint on a 6 months ending line here, up 29%. That is massive, obviously. Net income from continued operations is up when you look at a 9 month standpoint, up 72%. But this quarter obviously was pretty rough here, to 48% decline over the prior year. Not anything too crazy there. I mean, again, it looks like from what they're saying, a lot of this was one-time events that led to this decline to 470. And I think I can buy them because there's a lot of profit that come in the parks and experience business, and it is taking back over, folks. The parks and experiences are coming back strong. They really are, and here we get into the segment results as well. Obviously, you see here they created a entire line for content license early termination, so that's something, because that obviously hit them quite a bit, but nothing crazy when you look at expenses there. I mean, other expenses obviously increased. Somehow it was a negative line last year. I don't know how that makes sense. Interest expense did increase, obviously, and corporate unallocated share expenses increased as well. Restructuring declined. Nothing crazy when you look at expenses, from my perspective. Then if you look at if you add this content license termination, obviously they're boasting this as a $20 billion quarter, which is fine. I mean, I get that. That's all right. It's a one-time dealio for sure. This is the segment results we want, folks, that go into each thing. Now, they did recently, obviously, it's a lot less refined than it once was. They have two main segments now, which is media and entertainment, which obviously includes the direct-to-consumer and all of that ish. Then you have the parks and experiences and products category, which you saw came in at over a 100% increase, right? Doubled it. Even on a 6 months ending standpoint, doubled it. $6.6 billion. Now, the Disney Media Entertainment came in at 13.6, which was a 9% increase. Not obviously as much, but we're talking about over $1 billion increase here, which is darn significant. It's darn significant, folks. And if you look at this following quarter, it's going to be even nicer. We're talking about a $400 million box office weekend opening for Doctor Strange. And they really don't have competition until later this month. So Doctor Strange is going to be raking in money. So this line over the next quarter looks really nice to me. It looks really nice. Then we talk about Thor later in the year. There's so many, and Buzz Lightyear coming out in the same quarter too. There's a lot of big movies coming out for Disney this quarter. A lot of big movies. So keep an eye on this Disney media, but then parks is still going to continue to grow massively back to where really their original prowess. They'll get there, folks, as the demand is high right now. It's very high. This summer is going to be crazy for Disney. Crazy. So just keep that in mind. From an operating income standpoint, this is where you see kind of what I was talking about. The Disney Media segment declined 32%, and again, this is because cost of original content. We're talking about a lot of money spent on original content for Disney. You're going to see Boba Fett cost here. You're going to see, obviously, they're probably including some expenses when you talk about Obi-Wan that's coming up. There's a lot of expensive content. And Moon Knight 2 had to be a pretty expensive series to show. There were a lot of special effects going in there. Yeah, that's where you see that. But from a parks and experiences standpoint, this was a negative line a year ago, up to $1.7 billion, and on 6 months, 4.2 against the negative $500 million line prior. I mean, this is a massive increase, and again, is up, all things considered, 50% year over year from a quarter-end standpoint, and 83% 6 months ending. So that's really nice. When we look specifically at media and entertainment distribution here, this is where it kind of divides up there. Linear networks up 5, nothing crazy. Direct-to-consumer, this is obviously the Disney Plus line, up 23. And from content licensing and others was down 3%. Nothing crazy there. This is obviously the main segment here, and linear networks here. Not too bad as well when we talk about what we can do in the box office from. Yeah, I mean that's pretty cool. Nothing crazy there. I don't really care. We do like to look at direct to consumer, obviously, because this mentions the subscriber lines for each segment, and obviously we saw Disney Plus. They kind of divided it up a lot more. Total Disney Plus, though, you can see 33% up from a year ago, increase of 34 million. Sorry, that'd be the craziest thing ever. 34 million subscribers over the last year added. If you look at Disney Plus, when you look at from a domestic standpoint, was up 19% over last year, and internationally, which is excluding Hotstar, was up 39%. A growth of 11 million domestically, and a growth of 12 million when you look at internationally. So it's pretty fair there. So Disney Plus as a whole here, 28%. When you look at Disney Plus, Hotstar was up 42%, quite massively. 15 million added in the last year. ESPN Plus was up 16%. Oh gosh, I hate when I say that. 62% over last year. ESPN Plus, which is pretty massive. I mean, this was a dead service prior, and they're doing really good things on this service, finally utilizing it like they should. We're talking over the last year, growth around 8.5 million subscribers in the last year. That's fine for the ESPN Plus. I mean, it's not a massive service for them, obviously, but it's good to see continuous growth there. And from a Hulu standpoint, normal base Hulu up 10%. Hulu Live Plus TV up 8%, which is obviously pretty massive when you're talking about 300,000 subscribers over the last year. When you talk about the service being $80, that's pretty significant. That adds up quite a bit. And total Hulu up 10%. It's good to see it. Average revenue per paid subscriber. This is a line that you will see increase when they add the ad tier. Ad-supported tier to Disney Plus. You're going to see this line increase, but it did increase domestically 5%. Internationally 24%. Disney Plus Hotstar was increased 55%. Nice. ESPN, our global Disney Plus up 4%. ESPN Plus up 4%. I can't speak anything. And Hulu up 6% on the base plan, and live TV up 8%. We like to see it, folks. From a Disney park standpoint, that's right. There's a lot of great things here. Parks and experiences from a domestic standpoint to $4.9 billion against a $1.7 million line. Obviously, you see the massive growth there. And internationally, was doubled, but again, not massive, because you see still a lot of closures internationally, especially when you're talking about Beijing. There are closures internationally that aren't quite hitting yet. But once they do, this is going crazy. It's still a massive increase, but they're massively limiting and even locking down in certain places, because that's how they do, communist regimes. But, yeah, and consumer products was flat. So overall, we saw growth in a massive standpoint. Over 100% growth there. So we like to see it a lot. I am going to look at the balance sheet and see where that puts us. Obviously, with a quarter of not so great, lines from a. This is such a tiny little font. Why did you do this, Disney? I've never been hungry in my life all of a sudden, so I'm gonna go eat after this, folks. It's exciting. Total current assets. They're giving me a 6 months comparison, which I like. Total current assets did see a decline from a cash standpoint. Cash and cash equivalents saw a decline. So cash or total current assets saw a $2 billion decline there to 31.4. Nothing really crazy there from a total asset standpoint. A slight decline of $1.2 billion, 202.4 compared to 203.6. So I would really hope to see, given this cash decline, I'd kind of like to see a little bit more of a spend on potentially a little bit of deficit decline, a little bit of debt paying off. Total current liabilities looks like they did from an accounts payable standpoint, 29.6 compared to 31. So, $1.4 billion declined there in a total current liability standpoint, which I'm fine with. So when you look at from an actual equity standpoint, that is good to see. They actually increased equity because you can see here they paid off some of this long-term liability and this borrowings line as well. So that's good to see. Total equity at $90.6 billion compared to $88.5 billion. So a $2 billion increase there in equity. Not too bad when you're talking about half of the balance sheet is in equity. I like to see that. Now, what are we doing with Disney stock right now, folks? I can't lie to you. This stock is seeing a lot of negative sentiment because I can't tell you if Disney Plus is helping right now. I really can't. I mean, I hate to say it because them being, I guess, somewhat tied to Netflix is what caused the most recent massive decline here because of Netflix missing their line. Now, Disney hit their line massively, and guess what? They're still getting beaten down. Unfortunately, the market doesn't select a whole lot of winners right now, but in my opinion, Disney is a massive winner when you look at the future. This is a company that it's really raking in the money. I mean, what do you want me to say? We look at this line, and for a company trading at $180 billion market cap, we'll look at a total revenue line. Don't mind that. Hopefully you didn't throw up on that one. On just a 6-month standpoint, they brought in $41 billion. So this company on the year most likely brings in $100 billion, because you talk about the summer quarter being pretty massive for them, but most likely brings in $100 billion and a price to sales under 2, and they're still not even fully recovered, right? They're still not fully recovered from a park standpoint, and they're going to continue to grow from a media standpoint as well when you look at direct-to-consumer, as well as from a box office standpoint, as that continues to recover massively as well. So I really like Disney from a long-term perspective. I think it's trading too cheap at these levels. But that's what I have for you, and I hope you have a great day. I'll see you next time.